Greetings, everybody. Welcome to Liberty Call. Today is Monday, December 4th, 2023. Hope everybody's having a good day out there. It is a kind of a nice day here in Colorado. We did get a little snow, but looks like it's melting away and there's turkeys walking through my yard. So anyways, like I said, hope you had a good weekend. And if it is your first time watching Liberty Call, if you could do me a favor, if you could give me some thumbs up, like, share, subscribe, follows, and press that notification bell. All righty, well, let's go ahead and get into today's numbers. Most of the markets were red. Looks like the Dow Jones came back quite a bit. It was more than 100 points down most of the day, and looks like it came back. So starting out with the Dow, it was down 0.11%, 41 points, closed at 36,204. S&P 500 was down 0.55%, closed at 4569. NASDAQ down 0.84%, closed at 14,185. The VIX was up 3.64% today. It's currently holding at 1309. Canada was down 0.21, Brazil was down 1%, and Mexico was up 0.29%. Over in Europe, Germany was up 0.04, the UK down 0.22, France down 0.18, Netherlands down 0.1%, Spain up 0.37, Italy down 0.05, Switzerland up 0.6, and Portugal up 0.69. Russian exchanges were both in the red again today. MOEX down 0.89, RTSI down 1.67. And the Asian markets, the Nikkei in Japan was down 0.73%, Australia up 0.73%. New Zealand up 0.09. In China, the Shanghai down 0.29. The Shenzhen component down 0.62. China A50 down 0.7. DJ Shanghai down 0.38. Hang Seng down 1.17. And the Taiwan weighted down 0.1%. All righty. So again, it's kind of just feeling like we're waiting for the next Fed meeting in a couple of weeks to see what's going to happen. But, again, with all the economic indicators we've been going through the last few months, things just aren't real good right now. But, there's been reading articles, actually we'll cover it tomorrow, that I forget who or what company said this, but they zero chance of recession in the future and 4 rate cuts next year. So we'll see what happens there. All right, let's go ahead and jump over to the weekly update. A Friday rally turned an otherwise mixed week for stocks into a solid performance. The Dow Jones picked up 2.42%. The S&P 500 gained 0.77%. NASDAQ rose 0.38% for the week, and overseas were up 0.13%. Stocks move higher. The stock market digested November's robust gains for much of last week, but rallied strongly amid falling bond yields on the last day of trading. Market sentiment remained positive as the Fed's preferred measure of inflation showed ongoing signs of softening inflation pressures, boosting hopes that the Fed may be able to end its rate hikes and consider cuts sometime next year. Investors also welcomed news of solid spending in early holiday sales reports. Decline in bond yields reflect that the financial markets are positioning for a rate cut soon, even brushing off Fed Chair Powell's Friday comments, suggesting it was premature to consider monetary loosening. Of course, they've been talking about rate cuts since a year ago, or like a year and a half ago. They'd already just started the rate increases, and they were already talking about dropping rates. All right, inflation eases. The Personal Consumption Expenditures Price Index, the PCE, the Fed's preferred measure of inflation, was released last week, showing core PCE, excluding food and energy, rose 0.2% in October and 3.5% from a year ago. Both were lower than September's readings of 0.3% and 3.7%, respectively. Perhaps most notably, core prices rose at a 2.5% annualized rate over the last 6 months, close to the Fed's target rate, and a big improvement over the previous 6 months annualized rate of 4.5% ending in April. The report also reflected a slowdown in consumer spending, as October's 0.2% increase was lower than September's 0.7% gain, a possible indication of the impact of resumption of student loan repayments, higher prices, and shrinking savings. Economic data this week. Monday, we have factory orders. Tuesday, the ISM Services Index, and also the job openings and labor turnover survey. Wednesday, the ADP employment report. Thursday, jobless claims. And Friday is the employment situation and consumer sentiment. Just a small number of companies reporting earnings this week. Tuesday, we have AutoZone and MongoDB. Thursday, we have Broadcom and Dollar General Corporation. All right, so there's the weekly update. Let's go ahead and jump over to the market recap for today. U.S. stocks stumble as tech takes breather ahead of key jobs report. All right. On Monday, U.S. stocks experienced a decline as investors reassessed their bullish stance on technology amid rising treasury yields. The market took a pause from its recent gains, especially in the growth sectors like tech, as investors questioned the timing of potential rate cuts. The upcoming key economic data, including the monthly jobs report, is expected to influence the Federal Reserve's monetary policy decisions. The S&P 500, which reached its highest level this year on Friday with nearly 20% year-to-date gains, and the Dow Jones Industrial Average up over 9% for the year, both face pressure. Meanwhile, the NASDAQ Composite, having surged 37% in 2023, mind you, it dropped quite a bit last year, experienced a setback as Treasury yields rose. Tech stocks, particularly Alphabet and Apple Inc., contributed to the overall decline. Apple faced concerns about iPhone production disruptions, with reports of supply interruptions in India due to adverse weather conditions. Meta Platforms, the parent company of Facebook, saw a more than 2% decrease after CEO Mark Zuckerberg sold 680,000 shares in November, according to a U.S. Securities and Exchange Commission filing. Spotify Technology, however, rose over 5% after announcing plans to cut 1,500 jobs, or about 17% of its workforce, as part of cost-trimming measures amid economic challenges. Virgin Galactic suffered a 17% fall after Richard Branson mentioned he had no intentions of injecting more funds into the space travel company. In corporate news, Alaska Air faced a 15% drop following its agreement to acquire rival Hawaiian Holdings for $1.9 billion. Meanwhile, Ford stock rose 1% after the automaker reported a 0.5% decline in U.S. sales for November and resumed operations at key plants impacted by a worker strike. Crypto-related stocks, including Coinbase Global, MicroStrategy Incorporated, and Riot Platforms, rallied as Bitcoin briefly crossed 42,000 per coin, driven by optimism surrounding the potential approval of a spot Bitcoin exchange traded fund by U.S. regulators. All right. So again, good news, bad news. It's kind of just even at this point. All right. Let's move over to an article from the Washington Post. It's titled, 401k balances are down, hardship withdrawals are up, but it's not all dire. Let's see what they had to say. All right. This year has presented a mixed picture for retirement savers, with some enjoying double-digit returns while others grapple with challenges posed by inflation. Fidelity Investments, a major manager of workplace plans, reported a 4% drop in the average 401k balance to $107,700 in the third quarter. Similarly, the average 403b account decreased by 5% to $97,200, and IRAs were down 4% to $109,600. However, when viewed year over year, 401k and 403 balances saw an 11% increase, while IRA accounts were up by 8%. The total savings rate for the third quarter, comprising employee and employer contributions, rose slightly to 13.9% compared to the previous year. Despite these positive trends, Fidelity noted concerning financial moves by retirement plan participants. Retirement plan loans and hardship withdrawals experienced an uptick, driven by inflation and cost of living pressures. In the third quarter, 2.8% of retirement plan participants took a loan from their 401k, up from 2.4% a year ago. In-service withdrawals subject to taxes and early withdrawal penalties also rose. The reasons behind these withdrawals included medical expenses and avoiding foreclosure or eviction. While hardship withdrawals are generally taxed as ordinary income, new regulations under the Secure Act 2.0 will allow plans to permit employees to withdraw up to $1,000 per year for emergency expenses without the usual 10% early withdrawal penalty. $1,000? Really? It's not a very big emergency expense. Fidelity also expressed concern about participants tapping retirement savings amid financial uncertainty and advised individuals to carefully consider the consequences of such actions. So, all right. So people are pulling money out of their retirement plans, and things haven't really gotten too rocky yet. So we'll see what happens in the next upcoming months. All right. Last up, article from First Trust, Mr. Brian Westbury, the chief economist there. This week's article is titled Disinflation, Not Deflation. And I know it's something I've harped on a lot. People saying, we have the economy's deflating. It's like, well, not really. It's just slowing down. And so let's go ahead and dive into this. All right. The apparent decline in new home prices over the past year, with the average price down 10.4% and the median down 17.6%, has raised concerns about potential deflation. However, it's crucial to interpret these figures in context. New home prices represent a small fraction, around 0.04% of the total housing stock, indicating they might not actually reflect broader trends. Additionally, the shift in consumer behavior and builder strategies could contribute to the decline in average and median prices. Higher mortgage rates might lead buyers to opt for smaller homes, influencing builders to focus on constructing smaller and more affordable properties. While this affects average and mean prices, the price per square foot might remain more stable. To obtain a more comprehensive understanding of national home prices, analysts often turn to indices such as the Case-Shiller and FHFA, which adjust for variations in home quality and track the sales price of the same homes over time. According to these indices, home prices have increased by 3.9% and 6% in the past year, respectively, contradicting the notion of widespread deflation. The discussion also touches upon inflation indicators like the PCE price index, indicating a 3% increase in the past year. While this suggests a slowdown compared to the previous year's 6.3% gain, it doesn't imply outright deflation. The article argues that the current monetary policy stance, although tight enough to address inflation concerns in 2024, might not lead to a sustained period of falling prices. The author expects rate cuts potentially steeper than the market anticipates, hinting at a policy shift reminiscent of the inflation challenges of 2021 through 2023 in the coming years. And probably the best analogy I heard about deflation is that, if you say you weighed 150 pounds and you gained 100 pounds, during the first year of the COVID, and then the next year you only gained 50. So you could say, if the people who, do these reports and such, or people on the news, they'd be like, see, your fat inflation is down 50%. See, you've lost weight. Well, not technically, because you went from 150 to 250 and then you went up to 300 pounds. So deflation would be like you actually, instead of going up another 50 pounds, you actually dropped 25. That would be deflation. So anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.